Corporate governance and ESG, an introduction. Corporate governance has been described in many different ways. Here are some of the popular definitions. Corporate governance is the system of internal controls and procedures by which individual companies are managed. It provides a framework that defines the rights, roles, and responsibilities of management, board, controlling shareholders, and minority or non-controlling shareholders. Another definition is that corporate governance is the system by which companies are directed and controlled. A third definition here, corporate governance includes a set of relationships between a company's management, its board, its shareholders, and other stakeholders. Notice that some definitions and systems reflect what's called shareholder theory, while others reflect stakeholder theory. With shareholder theory, the emphasis is on running an organization so that the shareholders benefit. In other words, the objective is to maximize the value of the firm. With stakeholder theory, a larger perspective is taken where we consider not just shareholders but also other stakeholders. Coming now to different stakeholder groups and their interests. Shareholders own a company, so clearly their interest is that the value of the firm should be maximized. Managers and employees essentially run the company, and their interest will be to maximize their own compensation and to maximize their benefits. Shareholders identify and elect a board of directors to represent them. It is very difficult for shareholders to oversee the activities of managers and employees, and therefore they elect a board of directors to oversee the management of a company. Shareholders can be either majority shareholders or minority shareholders. Board of directors can either be independent or they might be representatives here who are closely linked with the company. Very often the CEO and CFO of a company are also on the board. We have creditors who lend money to the company. Obviously, the interest of creditors is that the company is stable, it generates cash flows so that payments can be made back to creditors. Suppliers would like companies to buy products from them and pay them well. Customers would like to get products from a company that are good quality but relatively low price. Often customers would also be interested in the long-term sustainability of a company. And finally, we come to the government or regulators. The government would be interested in tax revenue, so the profitability of the company would be important. The government needs to look out for the interest of the public, and regulators need to ensure that a company is following the relevant laws and regulations. With non-profit organizations, the stakeholders are slightly different because we don't really have shareholders. Here we have instead board of directors or trustees who need to ensure that the organization is following its stated mandate. Obviously, other stakeholders are similar. We have employees of the organization, we have regulators, we have societies at large, we have the patrons of the organization, the donors and volunteers. Coming now to the different relationships and conflicts that exist in the context of corporate governance. One of the most important issues has to do with shareholder and manager-director relationships. Let's start with shareholder and manager-director relationships. So as we said, shareholders own the company and managers run the company. The shareholders in this case are the principals and the managers are agents. In essence, managers are agents of the shareholders. So here there is an obvious conflict because what shareholders want is that the company value be maximized, whereas what managers want is higher compensation and higher benefits. So here is a potential conflict. To address this conflict, shareholders elect a board of directors, and then the board of directors is supposed to carefully oversee the managers and ensure that managers are acting in the best interest of shareholders. So here again there can be a conflict if the directors are closely aligned with management and are not acting in the best interest of shareholders. Now coming back to the shareholder and manager conflict, as I said, a major issue is that shareholders want the firm value to be maximized, whereas managers want their own personal benefits. Often the risk tolerance will be different between shareholders and managers. Managers who are interested in preserving their jobs might generally tend to be more risk averse than necessary. At times when managers have out of the money stock options, then they might take on more risk than is necessary. There is information asymmetry because clearly the managers have much more information than shareholders, and it is possible that the board of directors who are supposed to look after the interest of shareholders are influenced by insiders. So insiders would be those who are closely linked with the management of a firm. Another conflict is between controlling and minority shareholders. So I alluded to the fact earlier that we can have controlling shareholders and minority shareholders. Obviously, in this case, controlling shareholders will take actions that might compromise the interest of minority shareholders. Manager and board relationships. Here, a potential issue might be that management does not provide sufficient information to the board of directors. Shareholder versus creditor interests. Generally, shareholders would be interested in the growth of a firm so that the value is maximized, whereas creditors would be more interested in stability so that all interest and principal payments can be made. And then there are other conflicts also. There can be a conflict between customers and shareholders. There can be conflicts between shareholders and the government, and so on. Stakeholder management involves identifying, prioritizing, and understanding the interests of stakeholder groups, and on that basis, managing the company's relationships with these other groups. Now, that involves various kinds of infrastructures. We have legal infrastructure, which defines the legal framework in which companies operate. We have a contractual infrastructure, so this deals with the various contracts that a company might have with its employees, with customers, suppliers, and so on. Organizational infrastructure, this deals with the rules and regulations based on which the company operates. And then the government infrastructure, which has to do with general rules and regulations imposed on companies. The various mechanisms of shareholder management are shown over here. In general meetings, a company presents its financials to the shareholders. This typically happens once a year and is called the AGM, the annual general meetings. They can also be extraordinary general meetings. Then we have the board of director mechanisms. These are the mechanisms by which the board of directors oversees the company, and we'll discuss this shortly. The audit function helps ensure that companies are presenting financial statements that reflect the economic reality of the company. Then we have reporting and transparency mechanisms, policies on related party transactions which deal with any conflicts of interest, remuneration policies, say on pay, which is where the shareholders have some say on how much managers get paid, contractual agreements with creditors, employee laws and contracts, contractual agreements with customers and suppliers, and finally rules and regulations. So these are the various mechanisms of shareholder management. Coming now to the board of directors and various committees that fall under the directors. The board serves as the link between shareholders and managers and acts as the shareholders' monitoring tool within the company. The broad responsibilities are as follows. Number one is duty of care. Number two is duty of loyalty. The duty of care requires board members to act on a fully informed basis in good faith with due diligence and care. The duty of loyalty is the duty of the board member to act in the interest of the company and shareholders. The duty of loyalty should prevent individual board members from acting in their own interest or the interest of another individual or group at the expense of the company and all shareholders. More specifically, the board should guide and approve the company's strategic direction. The board should evaluate the performance of senior executives and ensure effectiveness of audit and control systems. The board should ensure that an appropriate enterprise risk management system is in place, and the board should review proposals for corporate transactions and changes. Now, to perform its various functions, the board creates several committees. Some of the most commonly created committees are shown over here. These include the Audit Committee, the Governance Committee, Remuneration Committee, Nomination Committee, Risk Committee, and Investment Committee. On this slide, we look at factors affecting stakeholder relationships and corporate governance. Broadly speaking, we have either market factors or non-market factors. Under market factors, these are the categories. Shareholder engagement deals with a company's engagement with shareholders, and the major events here are annual shareholder meetings and analyst calls. We can have shareholder activism. This deals with strategies used by certain shareholders to push a company in a particular direction. The primary motivation generally tends to be to increase shareholder value. There are various tactics that can be used, such as proxy battles, and the most common category of activist shareholders are hedge funds. Competition and takeovers. If a company is performing poorly, then managers might lose their jobs and directors might be voted out. The bigger picture here is that if a company is performing poorly, it also becomes a potential takeover target. And obviously, if a company is taken over, then the management probably will lose its job. There are various kinds of corporate takeover strategies, and at times companies might have anti-takeover measures in their corporate governance charter in order to discourage takeovers. Coming now to non-market factors, one major factor is the legal environment. Broadly speaking, there are two types of legal environments: a common law system and a civil law system. A common law system provides better protection for shareholders relative to the civil law system. Also, creditors are generally more successful in enforcing their rights relative to shareholders. Media can also play a major role. The media affect corporate governance and influence shareholder relationships. Over the last few years, the impact of social media also has been substantial. And finally, corporate governance industry. In recent years, several external corporate governance services have come up. These entities provide corporate governance monitoring, rating, recommendations, and proxy voting. Poor corporate governance can lead to weak control systems. When we have weak control systems, there is inefficient monitoring, and one stakeholder group can benefit at the expense of the company. With poor corporate governance, there will be ineffective decision making. It can lead to legal, regulatory, and reputational risks. And poor governance can also lead to default and bankruptcy risk. On the other hand, here are some elements of effective governance. Roles and responsibilities are well defined. There is an effective audit system. There is careful monitoring of compliance with internal policies and external regulations. Procedures to deal with conflicts of interest and third-party transactions are in place. There are proper compensation policies. There is high transparency. There is good creditor management. And all this leads to operational efficiency, improved control, better operational and financial performance, and lower default risk and lower cost of debt. Analyzing corporate governance and stakeholder management. This slide talks about the items that an analyst must be aware of when analyzing corporate governance. An analyst should evaluate the ownership and voting structure. So is there the typical voting structure, which is one share, one vote, or do we have dual class shares where different classes of shareholders have different voting rights? An analyst should evaluate the motivations of the controlling party. If the company is primarily owned by a founding family, then what are the generational dynamics? What is the succession planning? What is the relationship between the board and management? An analyst should evaluate the experience and skill set of the non-executive directors. Does the skill set of the non-executive directors meet the current and future needs of the company? One should evaluate the remuneration policy. Is the compensation aligned with shareholder interests? Is there a variation in results? And so what we are looking for here is whether the compensation of management is linked with the performance of the company. We should also compare the remuneration and compensation policy with other similar companies, and we should determine whether the compensation is relevant given the current state of the company or the current state of the economy. We should evaluate the various investors in the company. Are there cross-holdings? Are there affiliated stockholders? We should evaluate whether activist shareholders are involved in this company. Evaluate the strength of shareholder rights, compare with other companies. Obviously, if shareholder rights are strong, that is a positive sign. We should evaluate how well the company is managing long-term risks. Coming now to the final slide, ESG considerations for investors. ESG integration or ESG investing involves the consideration of environmental, social, and governance factors in the investment process. This is sometimes also called sustainable investing or responsible investing and even socially responsible investing. ESG factors in investment analysis. Investors are concerned with how a company manages environment factors. So companies that are doing a good job of pollution prevention, water conservation would be seen favorably relative to other companies that are not taking these environmental factors seriously. Similarly, investors are concerned about social factors. So companies that are concerned about human rights and community impact will generally be seen more favorably relative to companies that are not concerned about these areas. So the next question is, how do investors identify socially responsible and environment-friendly companies? And these are a few implementation methods. Negative screening involves screening out companies that are not performing well with respect to the environment or not concerned about social factors. Positive screening and best-in-class approaches refers to explicitly identifying companies that do well against these variables. Thematic investing strategies consider a single factor such as energy efficiency or climate change. Impact investing has to do with making economic investments that also have a positive social impact. An example would be buying climate bonds or green bonds. That is it for this reading.